Here, we're focusing on real estate financing, which is a critical aspect when it comes to buying property. Essentially, this involves methods like notes and mortgages. A note is a written promise to pay a certain amount of money at a future date, usually with interest. Mortgages, on the other hand, are loans specifically used to purchase real estate, where the property itself serves as collateral. Understanding these concepts is fundamental because they directly impact how individuals and businesses finance real estate transactions. It's important to grasp how notes and mortgages work together to facilitate property purchases and manage financial risk. When we talk about real estate debt, there are two main pillars to understand. First, we have promissory notes, which are essentially the borrower's written promise to repay the loan. It's a legal document that outlines the terms and conditions of the repayment. The second pillar is mortgages, which represent the lender's claim against the property used as collateral. This means that the borrower doesn't repay the loan. The lender has the right to take ownership of the property to recover the owed amount. Together, these two elements form the foundation of real estate financing. A promissory note is essentially the borrower's written promise to repay a loan. It establishes a personal obligation, which means the borrower is legally committed to paying back the debt. Within this document, you'll find the key terms of the loan, including the amount borrowed, the schedule for payments, and the maturity date when a loan must be fully repaid. The note also outlines the interest rate applied and explains how interest will be calculated and charged over time. Importantly, this promise becomes legally enforceable only once the borrower has signed the note. Promissory notes are commonly used in real estate financing, serving as a clear and binding record of the loan agreement. Let's talk about what a mortgage actually is. A mortgage is a security instrument that gives a lender specific rights to the property until the debt is fully repaid. Essentially, it secures the loan by tying it directly to the real estate involved, rather than just relying on the borrower's promise to pay. There are a few key points to understand here. First, the borrower pledges the property as collateral, which means if they can't meet their payment obligations, the lender has a claim on that property. Second, the mortgage creates a lien that stays with the property. So, if the property changes hands, the mortgage lien remains until it's satisfied. Third, if the borrower defaults on their payments, the lender has the legal right to foreclose and sell the property to recover the debt. Finally, once the loan note is fully paid off, the mortgage is released, clearing the lender's claim on the property. This process is fundamental to real estate financing. Let's talk about how notes and mortgages work together in real estate financing. The promissory note is essentially the borrower's personal promise to repay the loan. It's the document that creates the actual debt. On the other hand, the mortgage acts as a security instrument. It ties that promise to the property by giving the lender a lien, meaning the lender has a legal claim against the property as collateral. This mortgage secures the debt created by the note. If the borrower fails to repay according to the note, the mortgage provides the lender with the right to foreclose on the property as a remedy. So, in simple terms, the note creates the debt and the mortgage secures that debt with the property. Let's look at the key elements of a promissory note, especially in the context of real estate financing. First, we have the principal amount. This is the exact sum that the borrower agrees to repay, and it's clearly stated on the note. Essentially, it's the starting point of the loan. Next is the interest rate and terms. This section explains how interest will be calculated and charged. It also clarifies whether the loan has a fixed rate or an adjustable rate, and whether it is short-term or long-term loan. Finally, we have the repayment schedule. This is crucial, as it outlines when payments are due, how much is owed each period, and the deadline for paying off the full balance. Together, these elements provide a clear and enforceable framework for the loan agreement. Here we're looking at 4 common types of mortgage structures, each with distinct qualifications and rate behaviors. First, we have a conventional loan. This type isn't government insured, so it usually requires a stronger credit profile and a larger down payment compared to other options. Next is the FHA-backed loan. This one is designed to lower the upfront cash needed, making homeownership more accessible to people who might not have a large down payment saved. Third, VA loans are available to eligible veterans and active service members, often offering the significant benefit of no down payment at all. Finally, the adjustable rate mortgage starts with a fixed interest rate for an introductory period, but then adjusts periodically. This can mean lower initial payments, but the potential for changes later on. Understanding these options is key to choosing the mortgage that best fits your financial situation and long-term plans. Let's take a closer look at the differences between fixed rate and adjustable rate mortgages. Starting with fixed rate loans, these offer stability and predictability because your payment remains the same every month, covering both principal and interest. This means no surprises when it comes to your monthly budget. The big advantage here is that the interest rate doesn't change after closing, so you're protected from rate fluctuations. Fixed rate mortgages are best suited for long-term homeowners who want certainty in their payments. The trade-off is that they typically start with a higher interest rate compared to adjustable rate loans. On the other hand, adjustable rate mortgages begin with a lower initial rate and payment, which can be appealing if you expect to sell or refinance within a few years or anticipate rates to drop. However, after the initial fixed period, your payments can change because the interest rate moves with market indexes and is subject to caps. This introduces some uncertainty, since your monthly payments could increase over time. This loan type is better for short-term holders or those comfortable with potential rate changes. So essentially, fixed rate offers security at a higher starting cost, while adjustable rate offers lower initial payments, but with the risk of future increases. Let's walk through the mortgage process from the initial offer all the way to closing. It all starts with pre-approval, which sets the foundation by determining how much the borrower can afford. Next is making an offer on the property. Once the offer is accepted, an inspection is conducted to assess the condition of the home. Following the inspection, an appraisal is done to establish the property's market value. Then comes underwriting, where the lender thoroughly reviews all the financial information to assess the risk and verify eligibility. Finally, we reach closing, which is a critical step where everything comes together. At closing, the borrower signs a loan note, creating a binding promise to repay. The lender then funds the loan, releasing the necessary money to complete the purchase. Lastly, the mortgage is officially recorded as a legal security interest on the property. Only after these steps does the loan become real, and the real estate financing is complete. This sequence ensures a smooth and secure transition from offer to ownership. When a mortgage is executed and closed, the next crucial step is recording it in the local land records. This public filing acts as a notice to everyone, signaling that the lender has a claim on the property. Essentially, recording perfects the lender's lien, establishing their priority over any later claims that might arise. Now, it's important to understand the difference between signing and recording a mortgage. Signing legally binds a borrower to the loan, but recording protects the lender's interest by making it public and enforceable against third parties. So, what exactly gets recorded? First, the date of execution and recording is critical because it marks when the lien officially enters the public record. Second, the parties involved, the borrower and lender, are clearly named to establish who's granting and receiving the security interest. Third, the legal description of the property ties the mortgage to a specific parcel of real estate, ensuring everyone knows exactly which property is involved. And lastly, the loan amount is documented, clarifying the scope of the lender's secured interest. It's key to note that recording doesn't create the debt itself. Rather, it perfects the mortgage, making the lender's claim clear and enforceable against third parties who might come along later. This whole process of recording and perfecting is fundamental in real estate financing to protect everyone's interests. When a borrower fails to meet the terms of their loan, this is known as default. This usually happens when payments are missed, but it can also occur if the borrower breaks certain agreements or fails to pay taxes and insurance. To address this, lenders might offer forbearance, which is a temporary pause, reduction, or restructuring of payments. This gives the borrower some breathing room to recover without the lender immediately taking action. However, if the borrower does not resolve the default, the lender has the right to initiate foreclosure. This means the lender can take possession of property and sell it to recover the outstanding debt secured by the mortgage. Understanding these steps is crucial in real estate financing as they represent the different stages when loan repayment issues arise. Here we have an amortization schedule that breaks down how loan payments are applied over the life of a mortgage or similar loan. Notice that the total payment stays the same at $1,500 each year, but the way it's split between interest and principal changes dramatically. In the early years, most of the payment goes toward interest. For example, in year one, $1,120 is interest, and only $380 reduces the principal balance. Over time, the interest portion decreases, while the principal portion grows. By year 30, only $70 is interest, and a significant $1,430 goes toward paying down the loan, which is completely paid off by then. This gradual shift means equity builds slowly at first, but accelerates later on. Understanding this process is crucial because it highlights why early payoff strategies, refinancing decisions, and the total cost of borrowing should be carefully considered. Essentially, you're paying interest first and building equity later, so managing your loan wisely can save substantial money in the long run. Here we have an important concept in real estate financing, the loan-to-value ratio, or LTV. Essentially, LTV is calculated by dividing the loan amount by the property value, giving us a percentage. This ratio is crucial because it helps lenders assess the level of risk involved. A lower LTV means the borrower has more equity in the property, which generally makes it easier to get loan approval and can lead to better loan terms. Understanding this ratio is key for both lenders and borrowers to evaluate financing options effectively. Now, let's talk about the important role that credit and down payment play in real estate financing. First, your credit score is key. Higher credit scores typically open the door to lower interest rates, which can save you a lot of money over time. Lenders look closely at your payment history, existing debt, and credit utilization to determine your score. If your credit is weak, it might lead to extra fees or even denial of your loan application. Next is the down payment. A larger down payment means you're borrowing less, which lowers the risk for lenders. This often improves your chances of getting approved and can lead to better loan pricing. On the other hand, smaller down payments can increase the loan-to-value ratio, or LTV, which might trigger the need for mortgage insurance. Understanding how your credit and down payment impact your financing options helps you plan more effectively for buying a home. Here, we're looking at two common ways to borrow against the equity you've built up in your home: a second mortgage and a home equity line of credit, or a HELOC. First, a second mortgage is essentially an additional loan that's secured by your property. You usually borrow a fixed amount all at once, known as a lump sum loan. This comes with its own monthly payments separate from your primary mortgage. This option works best if you know exactly how much money you need up front. On the other hand, a HELOC functions like a revolving line of credit, also secured by your home's equity. You have the flexibility to draw funds, repay them, and then borrow again during the draw period. Keep in mind, variable interest rates are common with HELOCs. This setup is ideal if you anticipate needing access to funds over time rather than a single large sum. Both tools can be effective for real estate financing, depending on your specific financial needs and how you plan to use the money. Let's talk about subordination and lien priority, which are crucial concepts in real estate financing. When a property goes into foreclosure, the order in which debts get paid out is determined by lien priority. The senior lien, usually the first mortgage, has the highest priority and gets paid first from the foreclosure proceeds. This means the first mortgage has the primary lien position and the first claim on any sale proceeds from the property. Any junior liens, like a second mortgage, come after the first mortgage. They only get paid if there's money left once the first mortgage is fully satisfied. So, the flow of foreclosure proceeds moves from the top, starting with the senior lien, down to the junior liens. Understanding this hierarchy is key for anyone involved in real estate financing because it affects the risk and recovery potential for lenders. When we talk about what influences your interest rate, there are several key factors to consider. First is your credit score. This is a major player because a higher credit score usually means a lower interest rate, as lenders see you as less risky. Next, market conditions come into play. Interest rates fluctuate based on the broader economic environment and monetary policy. Then, the loan term matters. A shorter loan term often has a lower rate, but higher monthly payments, while longer term spread payments out with higher rates. Finally, your down payment affects the rate. A larger down payment can help secure a better rate since you're borrowing less. Now, it's important to understand the difference between the interest rate and the APR. The interest rate is simply the percentage charged to borrow the principal amount. The The APR, or annual percentage rate, includes the interest rate plus additional lender fees and finance charges, giving you a clearer picture of the loan's total cost. This distinction is crucial when comparing loan offers because the APR reflects the true cost of borrowing. Let's take a closer look at some key legal requirements and disclosures involved in real estate financing. First, there's TRID, which stands for TILA-RESPA Integrated Disclosure. This combines crucial loan disclosures into standardized forms that lenders must provide to borrowers both before closing and again at closing, ensuring transparency throughout the process. Next, we have TILA, or the Truth in Lending Act. This regulation requires lenders to clearly disclose the annual percentage rate, finance charges, and the total payment obligations, helping borrowers understand the true cost of the loan. Fair lending laws play an essential role too, prohibiting discrimination in lending decisions based on protected characteristics like race, gender, or age, ensuring equal access to credit for all qualified borrowers. Truth in Lending also offers borrowers a consistent way to compare loan costs across different lenders by standardizing disclosures. Finally, the good faith estimate is an early estimate of settlement charges and closing costs that borrowers can expect, helping them prepare financially as they move toward closing. Together, these requirements ensure borrowers are well informed, treated fairly, and protected throughout the financing process. Let's look at two common transfer structures in real estate financing: assumption and subject to purchase. With an assumption, the buyer formally takes over the existing loan and becomes personally responsible for repayment, typically with the lender's approval. This often allows the buyer to keep the seller's current interest rate and loan terms. Importantly, under an assumption, the buyer is directly liable for the loan, but the seller may remain liable as well unless the lender officially releases them from the obligation. On the other hand, a subject to purchase means the buyer takes ownership of the property subject to the existing mortgage, but the loan remains in the seller's name. The buyer usually makes the payments without replacing the loan. In this case, the seller stays liable to the lender, and there is a risk that a due-on-sale clause could be triggered, potentially requiring the loan to be paid off immediately. Understanding these differences is crucial when structuring a purchase, as they have significant implications for liability, rights, and obligations for both buyer and seller. Commercial real estate financing is fundamentally built on three key concepts: income, risk, and structure. When we talk about property types, it's important to recognize that office spaces, retail outlets, industrial properties, multifamily housing, and mixed-use developments all have unique underwriting standards. Lenders focus heavily on cash flow metrics, such as rent rolls, net operating income, and debt service coverage ratios, rather than just relying on the borrower's personal income. Loan structures tend to be different too, often featuring shorter terms, larger down payments, and balloon payments at the end. Unlike residential real estate, commercial properties are valued based on their financial performance, just as much as their location. Understanding these distinct factors is crucial when navigating commercial real estate financing. Let's look at the key differences between residential and commercial mortgages, even though they share the same basic debt structure. Starting with the loan amount, residential mortgages tend to be smaller and more standardized, whereas commercial loans are larger and typically sized based on the income generated by the property. When it comes to loan term, residential mortgages usually last between 15 to 30 years and are fully amortized, meaning the loan is paid off gradually over time. On the other hand, commercial loans often have shorter terms, around 5 to 20 years, and commonly include balloon payments, which require a lump sum payment at the end of the term. Interest rates also vary. Residential loans usually offer lower, fixed rates, providing predictability for borrowers. In contrast, commercial loans often have higher interest rates with variable or reset structures, reflecting different risk and market factors. Understanding these distinctions is crucial for properly evaluating and managing real estate financing options. When you have a mortgage, an important component to understand is the escrow account. Essentially, an escrow account is a reserve managed by your lender. Each month, along with your mortgage payment, you pay a bit extra that goes into this account. This extra money is set aside specifically to cover future bills like property taxes and insurance. Here's how it works. First, as a borrower, you include an additional amount in your monthly mortgage payment. Then, the lender holds this money in the escrow account, safeguarding it until those bills come due. When it's time to pay property taxes or insurance premiums, the lender uses a fund from escrow to take care of those payments on your behalf. Typically, the largest expense handled through escrow is property taxes, which are paid directly to the local taxing authority. Homeowners insurance is also commonly collected through escrow, ensuring your home remains protected without you having to manage separate payments. In some communities, if there are homeowners association fees or other assessments required by the lender, those may also be included in escrow. This system not only helps borrowers by spreading out these big expenses over the year, but also gives lenders confidence that these critical payments are made on time, protecting both parties. Here we're focusing on the distinction between a promissory note and a mortgage, two fundamental components of real estate financing. First, the promissory note is essentially the borrower's written promise to repay the loan. It creates a personal obligation for the borrower to make payments, outlining key debt terms like the loan amount, interest rate, payment schedule, and what happens if the borrower defaults. Think of it as the borrower's commitment to repay the debt. On the other hand, the mortgage is a security instrument tied to the property itself. It creates the lender's security interest in the real estate by pledging the property as collateral for the loan. The mortgage gives the lender a lien on the property and the right to foreclose if the borrower fails to meet the obligations set out in the note. So, the note sets the terms of repayment and the borrower's promise, while the mortgage protects the lender's interest in the property. Understanding these two documents is crucial because together they form the legal foundation of most real estate loans. Now that we've covered the essentials, let's focus on the next steps for getting started with real estate financing. First, it's important to check your credit, as this will affect the types of loans and interest rates you qualify for. Next, start saving for your down payment, which is a critical upfront cost in any property purchase. Then, take time to research different loan programs to find one that best suits your financial situation and goals. After that, getting pre-approved for a loan can give you a clearer picture of your budget and show sellers you're a serious buyer. Finally, find a reputable lender who can guide you through the financing process smoothly. By following these steps, you'll be well on your way to securing the right financing for your real estate investment.